My name is Louis Boulanger. I'm a CFA charter holder, and these days I'm a private wealth advisor, and I've come to the view some 5 years ago now that what's happening in today's markets, financial markets, is more a monetary crisis than anything else. And so the purpose of this presentation is to emphasize the ongoing role of gold, even though gold has been externalized from the monetary system for the time being, and explain why that is the case. So my background is that I've operated mainly in the institutional advisory market. I was with Mercer for 18 years, including the CEO of New Zealand operations. Now I have my firm and focus more on the private wealth side of things. So on with the presentation. The public who know me and what I talk about generally refer to me these days as a bit of a nutcase because I seem to emphasize the severity, the seriousness of the crisis, and unfortunately people tend to interpret that as me being a doom gloomer, saying that the end of the world is near. No, it's not the end of the world, it's the end of the monetary system as we know it that is near. And so it's important to prepare for what's coming and what is currently evolving. During the presentation we'll cover a lot of ground, various aspects I find of the meaning of gold and the role of gold in the financial system is very unknown, even to the CFA charter holder community. I've delivered this presentation in 12 countries at the invitation of CFA Society so far, and it never ceases to amaze me how much there is really little in-depth knowledge about the history of money or why gold matters. So I'll start the presentation with a few words on that. It's impossible to talk about gold these days and not say a few words as to whether or not its price is in a bubble. So I'll have a few slides on that as well. And probably the core part of the presentation, really getting into the key message, is the nature of this crisis, why it is what I think it is, and why we are currently right in the middle of what I would consider or call currency wars. There certainly is a currency warfare going on between nations. And we'll finish the presentation with a brief outline of bullion. What is bullion? How do you buy bullion? And how is bullion different to investing in gold and various forms of vehicles or means of doing that that exist in the financial market space. Well, let's start with a quote from Warren Buffett. If there's anyone who knows anything about making money, it's Mr. Buffett. And he says, if it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. Few would dispute that. But the problem today, or the real challenge today, is how do you do that exactly when money, as we know it, is being debased or on the way out for a replacement form of money. So, to me, in all the readings I've gone through over the past, let's say, 7 or so years, one of the most one of the shortest but most important reading to properly explain why gold is money or how gold came to be money is a short essay that was written by Karl Menger in German. He's an Austrian. He's the father of the Austrian regional economies. Many things can be used as money, and anything can be used as money as long as they meet 3 very important uses, and those are as a medium of exchange, as a unit of account, and as a store of value. Now, those are well known by the investment professionals as what are the uses of money, but we tend to overlook what they are in many instances as we become used to using a form of money without questioning its value. So this may be a little outrageous in terms of a question, but it's not so much the US dollar that could be on that slide. It could be any currency. Any currency in the world today is legal tender because it is declared to be so by the state issuing it, and so therefore its value is based on the ability of the issuing country to pay its debt. But you can apply the three uses to answer that question and decide, well, is it a good medium of exchange? Of course it is. You have well over 90% of world trade done in US dollars still to this day. Is it a good unit of account? Well, you could argue that it certainly is, because it's very easy to measure things in dollars and cents on both sides of the ledgers, and know exactly where you stand from that point of view. Is it a good store of value? That's where this particular currency, but many others, failed quite strongly, as it would now represent a purchasing power of about 2 cents compared to the full dollar it was when the Federal Reserve started issuing the notes about 100 years ago. And of course there's a little bit of history there, which I'll just touch on. Initially, as per the Constitution of the United States, what was called the dollar in the U.S. was actually a silver dollar, and it was clearly noted on the dollar that it was in fact a certificate that there was a silver dollar on deposit at the Treasury and payable on demand to the bearer of this certificate. Whereas now, although it looks very similar, it is merely a note of the Federal Reserve, and it's called a dollar, but there is no relationship and there's no redeemability. There's no ability to the holder of the note to redeem it for silver or whatever would be backing the currency. And so, as a result, there has been no restriction for quite some time in the ability of the central bank, or any central bank for that matter, to add to the money supply. This chart is from the Federal Reserve St. Louis website, and it shows the monetary base for the U.S. and it goes back to since the beginning of records issuing Federal Reserve notes, and we can see that whether you are concerned about the situation or not, we're living some unprecedented times with the vast acceleration and growth in the monetary base. Well, what's wrong with this picture? What's wrong with this picture is that we don't really know how it's going to end. But Thomas Jefferson, one of the founding fathers, warned the U.S. citizens that if the American people ever allow private banks to control the issuance of their currencies, first by inflation, then by deflation, the banks and corporations that will grow up around them will deprive the people of all their prosperity until their children will wake up homeless on the continent their fathers conquered. Quite a strong warning from Mr. Jefferson, although you could argue that it is precisely what is happening in the U.S. with the difficulties on the housing market, a lot of people losing their houses, and the debt of the country escalating at an ever increasing rate. I began writing in 2006 about the seriousness of the monetary situation, monetary system, and I called it the monetary tragedy of the 20th century. In a nutshell, what happened were a series of events, but the one that ended Bretton Woods as we knew it is the decision that was made by President Nixon in August 1971, 40 years ago, to no longer redeem on demand to other nations gold for their paper dollar reserves at $35 an ounce. And from that moment on, what resulted was an experiment, a global experiment of fiat-only money, which the world eventually, in 1980, 81, seemed to fully accept as something that should be tried, as there was no longer any concern with the system, as interest rates in the U.S. had to be increased. Paul Volcker, at the head of the Federal Reserve, had let interest rates go to where they had to in order to reinstitute confidence in the system, and that was achieved. But we are now living perhaps the second wave of the question mark over the monetary system that began after that effective default from the U.S. in 1971 and their obligation to redeem gold on demand. So the role of gold is very important, although it is now being carried out outside the system as opposed to within the system. And Alan Greenspan, a very interesting character in this whole affair, this whole play in the monetary world, has been saying some interesting things about gold during the time he was at the Fed, or before he became involved with the Fed, and also since he's left the Fed. This is one quote from him in 1999. At the time, England had just sold, or was in the process of selling, about half of their gold reserves, and the U.S. was wondering whether they should be doing the same, and Greenspan was questioned in a U.S. Senate committee whether the U.S. should or not, and this was his answer. He said, gold still represents the ultimate form of payment in the world. Fiat money, in extremis, is accepted by nobody. Gold is always accepted. The key operative words here are in extremis. So, of course, when confidence in the system of fiat money is in place and not in question, there is no problem. But in extremis, gold is always accepted. Needless to say, his advice to Senate was not to sell the U.S. gold, and they did not. Another important character in this history of our attitude towards gold today was John Maynard Keynes, a highly influential economist. Of course, the Keynesian school of economics is probably the predominant school of thought in economics today. And he never said that gold was a barbarous relic, but what he did say is that he felt the gold standard was already a barbarous relic. And that has been more or less accepted as a fact pretty much since then, and most importantly after Bretton Woods. But far from being a barbarous relic, gold is simply one of the most misunderstood assets in the world. And it would be naive to think that there is no governance worldwide of its price, especially these days, as a number of central bankers have admitted, including Paul Volcker some many years ago, as that gold was the enemy, if you like, of the monetary system, which was unfortunately had to be the consequence of throwing it outside the system back in '71. But despite all this, gold remains valued around the world, and in particular in the East, as central banks of the Western world have sold a lot of their reserves over the past 15 to 20 years, although they have stopped doing that over the last year. Why is that the case? It's because there is increasing lack of confidence in the ability of the issuing monetary states to pay their debt, and so they prefer to convert part of their assets into stateless money. The most famous quote that I'm aware of in terms of stating that gold is money came from J.P. Morgan himself when he was interviewed with a question by, I believe it was a U.S. Congressional Committee in 1913. He was asked what was the role of gold in the financial system, and his answer was very succinct. He said, gold is money and nothing else. Times have changed, as we have heard the current governor of the central bank recently in answering a question by a congressman committee that he felt gold was not money, but simply an asset. The other very important aspect of gold as an asset to own in these times of systemic crisis is that it is not anyone's liability. So if you own gold bullion, the physical metal, it's an asset that you own, which is nobody else's liability, unlike any financial asset that you can think of. Even a bank account is someone else's liability, an equity, a bond, and so forth. So it offers unique protection from systemic risk. But gold as a metal is an interesting commodity that has properties and characteristics that I could go on forever about, but the most important aspect to understand about why gold ended up being the most saleable item to go to market in earlier times and has remained the most appropriate or suitable commodity to be used as money has to do with the above ground stock of the material. If you think of any other commodity that's dug up from under the ground or that is harvested from above ground, in all cases the inventory, the above ground stock of that commodity will be at best a year or a little over a year's production. In gold's case, maybe with the exception of silver, but silver would not have many years of annual production above ground that is marketable, that is available to trade. Gold is the exception that stands out, and the above ground stock of gold is about 160,000 tons, and the annual production of gold is of newly mined gold as opposed to recycled gold is under 2,000 tons a year. So this gives gold a unique marginal utility as a commodity. It's got the lowest marginal utility for any additional supply brought in by mining, and this is effectively why it is still adopted as a store of value worldwide. Price is what people generally think of when they talk about gold or look at gold and get the impression that the price of gold is rising rapidly. What is in fact happening is more the opposite. It is the purchasing power of the currencies that the metal is priced in that is declining, and has been declining for some time, mostly over the last 10 or 11 years. It's unprecedented that there has been, for every single year over the last 11 years, a decline in the purchasing power of most major currencies relative to gold, and this chart illustrates. But unfortunately, in a way, we tend to focus more on the price. This table here shows in number of different currencies, as well as on average on the right-hand side for 10 currencies, the 6 shown on the table, plus the Canadian dollar, Chinese yuan, Indian rupee, and Japanese yen, what the average change in the price of gold has been over the past 10, 11 years. And what strikes me is that there might be a lot of volatility from year to year or from currency to currency, but on average, each year or on average, each currency shows a similar picture. And to me, that's quite interesting to observe. So the price has been rising in all currencies for quite some time. Therefore, the question is it in a bubble? The answer to be provided shortly. But to my mind, the gold price is an indicator. It's a barometer. It signals that there are problems with the fiat currencies. It signals that it's time for monetary reform. And I'm very pleased to hear more and more discussion on possible new post-Bretton Woods systems that are being discussed at either the G20 level or more regional forums. But that's very healthy, and we need much more discussion on that very important subject because we do need to reform our monetary system. But until we get there, it's very important to know how to prudently take all this into account in the investment management of whether it's private wealth or institutional money. And in my opinion, until we do get monetary reform with some form of recognition of the need for a numeraire, which we no longer have, a sound measure, unit of measure of value unrelated to paper, then it will be considered more and more as an alternative form of money to fiat currencies, and we're seeing that certainly even with central banks that have become net buyers of gold despite the highest nominal price ever. And eventually later we hopefully will have gold back as a numeraire or the anchor for the system. But to my mind, coming back to a point I made earlier on, there is sound governance of all this by central banks and monetary institutions in the world. And I think there is an inevitability of remonetization of gold globally, and the process is managed as best as they can, and the price should not manifest as a bubble for quite some time. Although there is obviously a risk that the gold price could end up in a bubble as it did back in the 70s.
Yes, a question?
But you say central banks are buying gold. You gave the example of Venezuela, and the guy's doing quite a lot of things different down there. Are they net buyers in Europe? Are they net buyers in America? Are they net buyers? I hear a lot about China.
Yeah, well, it's the World Gold Council issues official statistics about what happens in the gold market from the point of view of countries' official gold reserves. And if you add up all the gold reserves of all the countries, it was going down for about 20 years, and now since 2009, it's going up. So essentially, that's what I mean by central banks are now net buyers. Now, which central banks they are? Well, they're mainly in the East, not in the West. But the central banks who used to sell in the West don't sell.
Okay.
Venezuela is a different story.
Yeah.
They're not buying or selling; they're just shifting.
Yeah. Okay.
Was there another question?
Here's a chart from Casey Research chief economist Bob Conrad, which to my mind is a very good way of assessing whether or not we do have a bubble. And the chart goes back to since the end of Second World War, and it differentiates the period between the time when Nixon took gold took the U.S. or the world basically off the gold standard, gold exchange standard, and so before and after. And you can see that the red line is the price of gold in nominal terms. This is a semi-log chart, obviously. So it was at $35 an ounce. Then it started rising and went up to a maximum of $850 back in 1981. And it's currently sitting at the time this chart was prepared at $1,800. And that price movement of the gold is compared to what the price would need to be for the amount of gold reserves to be sufficient to cover the non-paper reserves of the states and central banks. And to my mind, that's a nice way of looking at what would be a shadow price of gold. You can do that too with various monetary supply measures, M1 and 2 and 3. But I believe, to my mind, this is a better approach, and it signals that the price would need to be $10,000 an ounce to achieve coverage with gold reserves of the amount of non-gold or paper reserves held by the world. That's one way of looking at it. Another way of looking at it is exactly what is a financial bubble. A financial bubble emerges when, of course, there's far more people buying whatever is claimed to be in a bubble than there is available or that could be justified rational thinking. And so look at this chart produced by CPM Gold, shows the percentage ownership globally in global financial portfolios going back to pre-1971. First bar on the left is 1968, where in fact people held gold in their portfolios. That declined to less than 1% by the time the 1990s began. And even despite this very significant rise in price, a six-fold rise in price, more or less, since the beginning of this millennium, there is still less than 1% of global financial assets in bullion, in gold bullion. So it doesn't appear to be a bubble from that point of view. You could argue that it may well end up being a bubble, but at the moment people simply don't own it yet. This chart, produced by Bullion Management Group, whether you agree that there's $200 trillion in world financial assets or a lesser amount, there's quite a number of sources that have a lower amount, some have a similar amount. Nevertheless, it's about 1.5 trillion the value of privately held gold today, so you're not far from, again, less than 1% of private and institutional ownership of gold bullion. About this crisis, I think Albert Einstein had a very good